Have you ever looked at a company's market performance and just wondered how a traditional manufacturing giant transforms into an absolute powerhouse? Well, welcome to this explainer where we're going to unpack the incredible, sustained winning streak of Parker-Hannifin. We're tearing down the financial data, the operational metrics, and the market sentiment to understand exactly what is propelling this company to historic heights. We've got a lot of fascinating ground to cover today, and we're going to rely on the hard numbers to tell the story. Let's get right into it.
Okay, let's dive into this. Picture this. On August 21, 2026, Parker-Hannifin did something that immediately grabbed the attention of every single person on Wall Street. It closed at $1,001.74 per share. Crossing that $1,000 psychological threshold, that isn't just a rounding error, it's a massive testament to the sheer scale of the company's success and the market's confidence in them. For a company in the industrials and aerospace sector, reaching this milestone signals that investors are pricing in something truly extraordinary.
But here's the wild part. That $1,000 closing price wasn't even the ceiling. Just a couple of weeks prior, on August 6th, the stock hit a 52-week high of nearly $1,100. So why the sudden spike? Well, the company released its Q4 2026 earnings, and honestly, it was a blockbuster. They reported a verified adjusted earnings per share of $9.27. That single piece of data triggered a wave of absolute euphoria, sending the stock surging by 7.3% in just a single day. The market wasn't just happy, it was downright exuberant.
To really put this into perspective, we have to look at how Parker-Hannifin is doing compared to the rest of the market. Year-to-date in 2026, the company has grown by 14.1%, while the S&P 500 sits at 11.6% over that same period. So this company isn't just riding a rising economic tide, right? It is actively outperforming the broader market. This establishes a really bullish case right out of the gate. But since we really want to understand the mechanics here, we don't just want to know that it's growing, we want to know exactly how. That brings us to Section 1, the engine, isolating the growth drivers.
And this brilliantly illustrates what's going on under the hood. Look at this stark contrast between their two main segments. On one side, you've got aerospace systems delivering a blistering 13.4% organic growth in Q4. On the flip side, the industrial segment is trailing with a much more modest 2.5% expected growth. So aerospace is clearly doing the heavy lifting here, currently accounting for roughly 11 to 12% of the total company's organic growth. It is unequivocally the primary growth driver right now.
Now, we shouldn't dismiss that industrial segment entirely. While 2.5% growth is definitely slower, it still has some really solid, reliable bright spots that provide a crucial baseline of support. Specifically, they're seeing notable strength in electronics and the ever-expanding data center business. Plus, there's a verified recovery happening in heavy-duty truck orders within their transportation vertical. So if aerospace is the rocket ship, you can kind of think of industrial as providing a very steady launch pad. But let's jump back to that rocket ship for a second, because this number is the absolute hero of our story today. $8.5 billion. That is Parker-Hannifin's record aerospace backlog. For you as an observer, a backlog of this size is vital because it gives them massive revenue visibility. I mean, it's literally money waiting to be made. Because of this backlog, the company expects aerospace organic sales to grow between 8 and 11% in fiscal 2026, alongside low double-digit growth in the aerospace aftermarket. The demand is practically locked in.
Let's move to Section 2, catalysts, fueling future growth. So Parker-Hannifin isn't just kicking back and relying on organic growth. They are executing a highly aggressive expansion strategy. In August 2026, they closed a mammoth $9 billion acquisition of Filtration Group. To understand the sheer impact of that, this deal alone is expected to add roughly $1.8 billion in sales in just its first 10.5 months. Add to that the pending $2.55 billion acquisition of CIRCOR Aerospace in the second half of 2026, and you've got a company voraciously buying up massive market share.
But they aren't just spending heavily on acquisitions. They are fiercely dedicated to returning capital to their shareholders. 70 years. Think about that. That means Parker-Hannifin has been consecutively increasing its dividend every single year since Dwight D. Eisenhower was president. It's a legendary track record. Right now, that dividend sits at $2 per share, which, when you combine it with buybacks, anchors a massive $2 billion in total shareholder returns. This kind of consistency, it's an absolute magnet for long-term investors.
And management is incredibly confident about where all this is heading. They verified $21.5 billion in fiscal 2026 sales with 6.6% organic growth. But when we look a bit further into the future, their long-term targets are pretty striking.
They're aiming for a massive 30% adjusted segment operating margin by 2031. Furthermore, analyst projections based on this trajectory suggest revenue could actually hit $25.2 billion by 2029. They are painting a very clear picture of a larger, much more profitable empire. Which brings us to a really vital turning point in our explainer. We've seen the euphoria, we've seen the record backlog, the massive acquisitions. But we have to pause here and ask ourselves a tough question. Is a great company always a great stock to buy at any price? Because operational excellence is one thing, market valuation is another entirely.
That brings us to Section 3, the reality check, valuation, and concerns.
Now, what's really interesting here is the hidden trend. The major firms, Raymond James, JP Morgan, Wells Fargo, they all maintain a buy or outperform rating. They clearly love the company. Yet, they are quietly trimming down their price targets. Raymond James cut theirs to $1,050. Wells Fargo cut to $950. And Wall Street Zen actually downgraded the stock entirely to a hold in August. So why the sudden caution?
Well, it really just comes down to the price tag. According to a recent GF value assessment, the stock appears 36.8% overvalued right now. The trailing price-to-earnings ratio sits at an elevated 33.67, and what this tells us objectively is that the sheer excitement of that 2026 run-up has heavily stretched the valuation multiples. Basically, you're paying a very high premium for this growth today, which heavily reduces your margin of safety as an investor.
When we synthesize the core risks here, a pretty clear picture emerges. First, as we just saw, is that steep valuation premium. Second, there is severe integration risk. Digesting the $9 billion Filtration Group and the $2.55 billion CIRCOR Aerospace simultaneously is a massive operational hurdle. Integrating over $11 billion in new assets flawlessly is incredibly difficult for anyone. And finally, you have that lagging industrial segment softness acting as a slight drag on overall margins.
Let's bring it all together in Section 4. The bottom line. Synthesizing risk and reward. So despite those trimmed price targets and the high valuation, the broader consensus on Wall Street actually remains a moderate buy. With 17 buy ratings versus only 4 hold ratings, it's pretty clear that the street still largely believes in the underlying fundamentals of the business. The backlog is real, the dividend is real, and the aerospace demand is simply undeniable.
So the crucial point is this. The hesitation isn't about the quality of the company. It's about the math of the stock price. The average analyst price target is approximately $1,039.70. With the stock already trading just over $1,000, that implies only about a 5% upside from current levels. Because the current price is so high, the immediate financial upside, essentially your margin of error as a new investor, is now incredibly narrow.
Which leaves us with the ultimate question as we wrap up this explainer. You've seen the staggering $8.5 billion backlog, and you've seen that premium 33 trailing PE ratio. Is all of this amazing news already fully priced into the stock, leaving very little room for error? Or is Parker-Hannifin, powered by these massive new acquisitions, simply clearing the runway for an entirely new era of growth? The numbers are clear, but the next move, well, that's up to the market. Thanks so much for joining this explainer. I'll see you in the next one.